Welcome back to episode 8 of the Groundfloor Market Trends podcast. I'm Patrick Donahue, your host, and today we're diving into two key topics shaping the real estate market: the housing policies of the 2024 presidential candidates and how changes in interest rates are impacting real estate investors day to day. If you've been wondering how Kamala Harris and Donald Trump plan to address housing affordability, homeownership, and renter protections, or how to navigate the current lending environment, this episode is for you. We'll explore the Fed Reserve's recent moves, assess what they mean for real estate, and offer actionable strategies to help investors position themselves for the opportunities ahead. So let's get started. Both Harris and Trump prioritize first-time home buyers, but their strategies take different forms. Harris' plan provides $25,000 in down payment assistance for first-generation homeowners, along with a $10,000 tax credit for first-time home buyers. These measures offer direct financial support to individuals who need help overcoming financial barriers to homeownership. Trump's campaign focuses on tax incentives to encourage homeownership, such as mortgage interest rate deductions and some other tax credits. While Trump has not released the full details of his proposed incentives, this approach aligns with a traditional conservative strategy that rely on private market and tax relief to stimulate homeownership. Both platforms aim to expand access to homeownership, but Harris emphasizes direct financial aid, while Trump leans towards deregulation and market-driven solutions, whatever they may be. This divergence reflects each party's broader economic philosophy. Harris focusing on government-backed programs to assist buyers, and Trump emphasizing the role of tax relief and private investment, whether or not it comes, in boosting the housing market. Both candidates recognize the increased need for housing supply, and it's crucial in solving affordability challenges, but their proposals reflect different priorities. Harris's strategy aims to build 3 million affordable homes within the next 4 years and expand the low-income housing tax credit. It also plans to introduce a neighborhood homes tax credit to spur development in underserved areas. Additionally, she has proposed a $40 billion innovation fund to help local governments address supply constraints creatively. Trump's campaign focuses on reducing regulatory barriers that increase development. He has pledged to cut environmental and permitting regulations to accelerate construction and open federal lands for housing development. These initiatives align with Trump's belief in market-driven solutions, where fewer restrictions encourage private developers to build more efficiently. Both candidates also tackle zoning regulations, but their solutions reflect different priorities. Harris proposes streamlining permits and converting office spaces into residential units to address supply challenges quickly, especially in urban areas. Trump focuses on easing environmental compliance rules and revisiting previous efforts to reduce zoning restrictions in suburban areas, although his campaign has not provided specific details about how those regulatory changes would be implemented. And when it comes to renter protections, Harris supports aggressive legislation, including the Preventing the Algorithmic Facilitation of Rental Housing Cartels Act, that's a mouthful, and the Stop Predatory Investing Act. Both target large-scale investors and looks to curb the influence of those large-scale investors. Trump's campaign, by contrast, has not introduced new protections, pointing instead to previous pandemic eviction moratorium as an example of supporting renters during crises. So for renter protection, it seems as though Trump is waiting for another disaster. The influence of interest rates on real estate investment strategy. Now let's shift gears to interest rates and their impact on real estate investors. Over the past 2 years, inflation has declined significantly. prompting the Federal Reserve to reduce the Fed funds rate by 0.5% in September of 2024. This rate cut signals a shift towards stability and suggests the Fed cycle of aggressive hikes may come to an end. Even though borrowing costs remain higher than in the low-rate environment of the 2010s and the early 2020s, the recent rate cut offers the hope that financing conditions will improve in the coming months. However, we are still experiencing tighter profit margins, and the slower pace of new developments does continue to present challenges for investors. This week, noted housing and construction analyst John Burns published 3 very important keys to watch, so let's discuss them. The intriguing puzzle of why mortgage rates rose after the Fed dropped rates. This phenomenon can be attributed, according to Burns, in part to rising long-term inflation expectations, which are causing some lenders to remain cautious despite the Fed's recent policy shift. Secondly, the 50-year low in existing home sales last month. Burns suggests the sharp decline is partially linked to recent Sitzer-Burnett real estate agent commission settlement, which has introduced clouds of uncertainty into the agent commission structure, affecting how homes are bought and sold. The significant reduction in home buying and rental demand in some of the country's formerly hottest markets is Burns' third concern. He cites a decline in domestic migration has cooled demand, particularly in states like Texas and Florida, which saw a boom in pandemic-era relocations. Understanding these trends will help investors stay ahead of market shifts and identify the best opportunity as the housing market adjusts to these evolving conditions. The Groundfloor Flywheel Portfolio is a powerful investment engine for any market. At Groundfloor, we've built the Flywheel Portfolio to thrive no matter what the market or policy environment looks like. Whether inflation resurges or interest rates fall or market conditions shift due to political changes, the Flywheel Portfolio keeps your capital working continuously. The Flywheel Portfolio is a diversified, automated investment vehicle designed to maximize returns through continuous reinvestment while also allowing for liquidity. And here's what makes it effective. The automated reinvestment ensures that your earnings are immediately reinvesting, compounding your returns over time. Broad diversification across different real estate loans minimizes risk while enhancing potential growth. And it has a natural inflation protection through real estate's intrinsic value and intrinsic guard against inflation. When rates and home buying activity hit the sweet spot, the flywheel will be there to keep turning and offering those high-yielding opportunities. The Flywheel Portfolio offers a powerful combination of stability, growth, and flexibility, positioning you for success whether the market expands, contracts, or stabilizes. No matter the outcome of the election, it provides the ultimate hedge against uncertainty and ensures you're always ready to capitalize on opportunities. Here are my closing thoughts. The 2024 election will undoubtedly shape new housing policy. But the key to success lies in staying informed and prepared. Harris's affordability-focused agenda does contrast with Trump's tax incentives, whatever they are, and deregulation efforts. But no matter what happens, the Groundfloor Flywheel Portfolio will help you navigate market fluctuations with confidence. Thank you for tuning into this episode of the Groundfloor Market Trends Podcast. Don't forget to subscribe so you never miss an update. I'd love to hear your thoughts. Do you favor one candidate's housing plan over another? If so, let me know. You can drop a line. And how are you adjusting your strategy in light of the Fed's recent moves? Until next time, happy investing. To learn more about the Flywheel Portfolio and start building your wealth, visit groundfloor.us today.